China threatens to break up Evergrande in an attempt to contain its property crisis. I'm your host, Steven Van Metre, and thanks for joining me today in what is being billed as the next catalyst for the global real estate financial crisis. China is attempting to ring-fence the problem with Evergrande as it is unable to pay its creditors. And China, with already enough eyes with the Olympics coming up, does not need more attention if its property sector takes the global economy down with it. But this isn't just a story with China. It's really a story of the dollar. But let's start out with this headline from Bloomberg as China weighs breaking up Evergrande to contain the property crisis. Proposal calls for Evergrande to sell most of its property assets. Its electric vehicle and service units would be initially kept intact. And Evergrande's restructuring proposal calls for the developer to sell most assets except for separately listed property management and electric vehicle units. The builders told creditors it aims to issue a preliminary restructuring plan in the next 6 months and intends to treat all categories of bondholders equally. And for those holding dollar-denominated bonds, they must be happy to hear that. People familiar with the matter have said that U.S. investment firm Oaktree Capital is moving to seize a plot of land used as collateral by Evergrande, the Financial Times reported. A Bloomberg Intelligence index of real estate stocks slid as much as 4.9% on Thursday, with the record declines for Times China Holdings Limited after it placed new shares in Hong Kong and Logan Group Company, which sold equity-linked securities to refinance existing debt. Evergrande fell 4%, while prices in China's high-yield dollar bond market fell for the first time in more than a week. And here you can see in this chart that if you're looking for a discount on Chinese bonds, well, they're at liquidation prices, according to this headline from Bloomberg, as China's property stocks are near the lowest valuation on record. And for those of you who remember the great financial crisis, well, it starts to look awfully similar. But let's keep going with the story because, again, we haven't even gotten to the point where the real issue is the dollar. But the developer said in a statement on Wednesday that it plans to come up with a preliminary restructuring proposal in the next 6 months. It earlier urged offshore bondholders not to adopt aggressive legal action over repayments. After all, after an ad hoc group of holders said the company failed to substantively engage with it over restructuring efforts. But hey, just don't sue us. Evergrande has started the process of identifying bondholders and plans to hire additional financial and legal advisors. Certainly sounds to me that they're just trying to buy time. We'll see if it works out for them or not. Evergrande's cash crunch has become a focus for global investors concerned that a collapse might spark a financial contagion and curb growth in the world's second largest economy, which depends on the housing market for about a quarter of gross domestic product. And if you're concerned about another financial crisis and what that means to your portfolio, well, you shouldn't be. Check out Portfolio Shield. You'd be glad you did. Let's continue on with the story because Wall Street Journal jumps on bandwagon with Evergrande asks overseas creditors for more time as the embattled Chinese developer makes second attempt to placate frustrated global bondholders. Well, you can't blame them. They're not getting paid. The plea came days after a group of international bondholders threatened to enforce their legal rights against Evergrande, saying they've been unable to engage substantially with the troubled Chinese real estate company for months. Advisors to some Evergrande bondholders last Thursday released a statement accusing the developer of withholding crucial information about its liabilities and failing to engage, despite statements to the contrary. Evergrande, which is roughly $20 billion in international debt outstanding and around $300 billion in liabilities, has struggled to meet its financial obligations since the summer and is deemed to be in default by all three major credit rating companies. Its bonds now trade far below face value, as we've already seen. And now we get into the story, which is perhaps the real story of the situation, is the dollar shortage. And with this headline, we'll go back to Bloomberg as Powell's hawkish determination is firing up bets on the dollar. As Powell did not pull any punches, say strategists at TD. Policy surprises from the Fed are adding support to the dollar. An index of the greenback strength jumped to a 5-week high on Thursday as investors said Fed Chair Jerome Powell's comments reveal a surprisingly aggressive stance on tightening monetary policy. And the issue I want you to understand is why this is a story for the dollar is because what does Evergrande and all these other property developers need to pay their U.S. dollar-denominated bonds? They need dollars. And if there's a dollar shortage or the dollar starts to rally, well, you get the idea that an unwind is likely to come. And that's why I think the story is really about the dollar. And if it goes higher, well, the question will be is, can Beijing ring fence this thing, or is it too big and brings the global economy down with it. Let's keep going, because here you can see a chart of the dollar symbol DXY, and it's breaking out of a range. And you notice I'll draw on this purple line, and when it breaks out, it threatens to go higher. And if you can imagine, if it gets back up into 100, what that means is a lot of pain for people holding dollar-denominated debts. And we haven't had a policy surprise from the Fed for a long period of time since Stephen Barrow, the head of excess strategy at Standard Bank, that creates a big risk for currencies and support for the dollar. And what you have to understand here from China's position on this is if the dollar rallies, well, what does the yuan do? Well, it goes down. And that's a problem, because now in order to get those dollars that these property developers need, they have to sell more assets and drive prices even lower. And you start to get the picture of how quickly and easily this can blow up. Let's keep going, because historically dollar strength has tended to wane as the Fed settled into a more predictable hiking cycle. But this time looks different. Well, maybe there's a reason it looks different. That's because here we have the trade balance of goods and services in blue shown as the balance of payments, and against the nominal broad US dollar index shown inverted. So what we tend to see is when the trade deficit widens, well, the dollar tends to go up in value. And part of the reason that happens is we start to export more dollars. But if the US financial system isn't creating enough new dollars through lending, well, the dollar goes up in value because it starts to tell us there's a dollar shortage. And what you see when the dollar rises is it's telling you current financial conditions are tightening. It's very important to understand, because what's happening with the trade deficit? Well, we got that data this week, and the preliminary data says it went to a new record level of minus 100.96 billion. At least, again, this is preliminary, but it is a record level if that number sticks. And Powell did not pull any punches on the potential need to tighten aggressively. TD Securities strategist, including Jim O'Sullivan, wrote in a note, this supports our bias for further U.S. dollar resilience early this year. Well, Jim, I think the dollar is going to go up a whole lot more than it is now. And when you start to understand that financial conditions are tightening, one of the reasons you see bond prices follow it higher and you start to see an increase in volatility is because all a treasury bond is a deferred dollar. And once you understand that, then you understand why when the dollar goes up, bonds follow, and everything else starts to fall apart. Because what it's telling you is not just current financial conditions are tightening, it's telling you future financial conditions are tightening. And with that, we'll see you soon. Bye now. The content of this video provides educational information and is not intended to provide investment or advice. It is not to be construed as recognition or solicitation by selling security, financial instrument, or participate in any particular trading strategy. This video was prepared by Steven Van Metre, personal capacity. The opinions expressed in this video that are not effective Atlas Financial Advising or Steven Van Metre Financial.